belief, structured products are not magic. And you definitely don't need to be a rocket scientist to understand how they work. Structured products are investment vehicles built by combining different financial instruments, such as bonds or options. They are bought by institutions, high net worth individuals, or retail clients. The level of capital at risk is predefined. These products are also designed with two objectives in mind: yield, if the investor wants to get a frequent coupon or higher income, or participation, to have exposure to the growth of an investment asset class. The investor needs to select how long they want the investment to last. These investments provide a return based on the performance of an asset, for example, indices, funds, interest rates, currencies, commodities, or even property. With all these factors in mind, each product is unique with their own risks and advantages as well. To simplify, we've split the products into three categories. Let's start with capital protected products. When investors seek to get back what they invested at the end of a period of time plus a return in excess of deposit rates, they've been using capital protected products. Their return is similar to bonds and they are mainly used to protect capital when the market is choppy. In this particular case, as long as the issuer remains solvent, the product returns the capital at maturity and the potential return depending on the underlying asset. The advantages of investing in capital protected products include protecting your initial investment, providing a potential higher return compared to deposits or bonds, flexibility, as they can provide investors with participation in different asset classes. But the risks are credit risk. The investor is subject to the issuer's risk of default. Liquidity risk, the investor needs to wait for maturity to get their capital back. And finally, the issuer or distributor may charge investors a fee. Moving to yield enhancement products. These products are used when investors agree to forego protection of their capital to earn an income that beats deposit rates or the yield on the related asset. They usually have some level of protection, but if the market goes against investor expectations, they could potentially lose some or all of the investment. The advantages of investing in yield enhancement products are higher potential returns, capital protection up to a certain depreciation of the underlying, return based on a particular market view, example positive return if markets go sideways or down, and flexibility, as they can give investors exposure to and participation in different asset classes. But there are also risks. Credit risk, the investor is subject to the issuer's risk of default. Market risk, as the investment is not protected, investors can lose it if the underlying doesn't perform according to expectations. And finally, the issuer or distributor may charge investors a fee. Finally, let's talk about leverage products. These products are used when investors are willing to put their capital at risk to significantly outperform the price performance of the related asset. They provide a higher return, but if the market does not perform according to expectations, investors can lose everything they've invested. For leverage products, the advantages of investing are higher potential returns, return based on a particular market view, example positive return if markets go sideways or down, and flexibility. They provide access to or participation in different asset classes. The risks are the same than for yield enhancement products. Credit risk, market risk, and finally, the issuer or distributor may charge investors a fee. Why do people invest in structured products? Structured products provide investors with any risk-return profile. Investors can select their market view and get a return besides buying or shorting the asset. Finally, structured products allow investors to shape the distribution of their portfolio.